Well, hello, I'm Chris McAlpin with Sound Financial, and I hope you're doing well today. I know that there is a lot of news out there about the stock markets and about the economy. You're all feeling this as you go to the gas pump or you go to the grocery store and you see how prices have risen. And the S&P 500 here recently, or as I'm recording this, has entered a bear market space. The definition of a bear market, and this is why I wanted to do a mid-month update, just to get some information out there, say, hey, listen, we're watching things, we've got a plan. And shortly, I'm going to describe that plan. But you're going to hear a lot of different catchphrases. And in these updates, I'm going to give you the definitions of them, okay? A bear market, here, quick definition. From the peak of the S&P 500's index, what that maximum number is, I think it was on January the 3rd, to today, it's lost 20%. Now, don't get me confused. That does not mean that your account has necessarily lost 20%, but that index has lost 20%. And so on the news channels, they're going to grab a hold of this. They're going to jump on this topic hot and heavy. And you're going to see a lot of, quite frankly, fear out there. And people are going to talk about this a lot. So let's dive in and let's look at a couple of topics that I think will help us understand what we're seeing. And y'all remember this screen. This is how I did the presentation in early April. And I left it just like this because, yes, 2022 feels stormy, and we knew that it would, okay? So how are we seeing this situation? What do we expect to see? Well, I said at the beginning of the year, inflation and rising interest rates are going to be the topic all year long. So the rising cost of things, what you're seeing or what you're feeling when you go to the grocery store, when you go to the gas pump, this is inflation. Rising interest rates. The Federal Reserve is raising interest rates to fight inflation. You remember I described the economy. You have sellers, you have buyers, and the fuel is money. When the Fed raises interest rates, it takes money out of the economy and it cools it off. The fear is that they're going to cool it off into a recession. Last, but certainly not least, Russia attacked Ukraine. We already know this. It's already on the news, all over the news cycle. They're fighting in the breadbasket of the world, which is going to affect grocery prices, plus massive oil shortage in many ways due to the sanctions against Russia's oil and natural gas. That's slowing down supply. Remember the sellers? And now the buyers, the demand is going higher because China's reopening after their zero COVID policy, and they've shut down major cities. They're reopening those, so you have more buyers of the oil on the market. Gas prices are probably going to continue to go up. So let's look at the Fed. So let's look at our own country and what's going on here, okay? So the Federal Reserve has a dual mandate. That means they have two jobs. There's always the third unofficial one of them managing the markets, but they have a legal dual mandate, and that is price stability and low unemployment, or in other words, maximum employment. Right now, for every person looking for a job, it's estimated that there are two jobs available. So the United States is at maximum employment, which gives the Fed a lot of cover. But in this seesaw, the prices are very unstable. Both inflations and recessions cause price instability. So the Fed is focused on price stability. As they raise interest rates, those interest rates go up, the bond prices come down. This is where you have been feeling the most pain in your portfolio this year. We use bonds to go be conservative. Let that sink in a minute. That is traditionally the space that we go to be conservative. Now, listen, I don't want there, please don't panic on this topic because I've described how a bond works. It is a repayment of debt. So inherent in its design, the holders of those bonds, which you're holding ETFs, or a lot of our clients are holding ETFs in this, it's designed in many ways that a lot of that money can be made back, okay? And so what we believe is going to happen, and we'll talk about this a little bit more in a minute, but let's dive in now. As these bond prices have come down, we believe that there will be a rally, especially in US Treasury bonds, okay? And so second part of what's going on in the markets and what's going on in your portfolio, is stocks. Okay. So now this year we took a conservative step in our clients' accounts on February 1st in bonds. And so half of that portfolio has basically been in cash. And what is it? Historically considered a cash position. Now that position has lost to inflation. Okay. And you see that on your reports. So that's half of our fixed income or our bond position. And now on May 31st, for many of our managed accounts, we sold a lot of stocks that had fallen beneath our risk trigger, which is the 10-month moving average. So we've taken a big conservative step in stocks already before this month ever started. Okay. Now, what I want you to notice here, well, didn't mean to do that. Let's go back. So what I want you to notice here, let's get me a pen, is how markets move. Okay. How do these markets move? You see back here, this ebb of the market of the tech wreck back 20 years ago. So tech markets, the markets there sold off. Then they entered this period of time, 02 through 07, where they grew, sold off again, 08 and 09, grew through this period of time. 2015, 16, tried to sell off again, but they did not because the Fed stepped in. That's going to be very important because they grew here through 2018, tried to sell off again in 2018, did not do it because the Fed stepped in again. 2020, Federal Reserve and the federal government stepped in. COVID, pandemic, completely different story, not arguing the fault there of them stepping in, okay? But in this period of time, now we're facing a sell-off in the stock market again. Now, markets cycle traditionally. When I say traditionally, thousands of years. Go look in the Old Testament. Short-term debt cycle there was 7 years. Guess what the short-term debt cycle is right now? 5 to 7 years. Wow. Looks like God knew what he was talking about. So we see markets wanting to cycle. They want to ebb and flow. And when it did not do this back in 2015 and 16, it built up a lot of pain that we believe we're going to experience here in 2022. Keep that in mind. That these ebbs and flows, and if the markets don't ebb and flow, they boom and they bust. And we're watching for that. All right. So what are we going to do about it? That's extremely important. So we want to control what we control. And you've heard me talk about this a lot. What are our investment rules? Okay. So avoid large losses, that being number one. We're selling losing stocks at the moment. And for most of our accounts, this is not everyone, this is not a blanket, this is a pretty blanket statement because this is on average across most of our accounts. We have approximately 40% cash or a cash equivalent in those managed accounts. We've already taken tremendously conservative steps while seeking to stay invested or stay within our system. And that way we're avoiding large losses. Because keep this in mind, let's go back one more screen. What's the overall trend that we're seeing here? And that is of growth, okay? Watch this over the last 20 years. Through all these boom and bust periods, we still have growth. We want to stay invested within a system so that you can reach your investment goals, or more importantly, your financial goals. But we want to avoid large losses. Number two, we want to invest in winners, okay? The Federal Reserve has two choices right now. They can, A, continue to tighten, or B, they can loosen. And so we believe right now they're going to continue to tighten to kill inflation and probably push the economy into a recession. I'm going to define recessions in the future for you. But if they continue to tighten, we believe US Treasury bonds will grow in both cases. If they continue to tighten, they're going to grow because as the economy ebbs off, interest rates fall with the economy and the price of those bonds rise. If they loosen, they're going to loosen by intentionally lowering interest rates, which will cause those bond prices to rise. In both cases, we cannot come up with a third scenario. two scenarios of them tightening or loosening. And in both cases, we absolutely believe that US Treasury bonds will rally, and that we believe we're seeing the bottom of that market right now. We want to stay invested in those US Treasury bonds. In fact, we want to pivot to longer term US Treasury bonds to get the benefit of that growth. Now, let me tackle one thing, one problem child that we have. And that's, you would see the ticker on your reports of PTBD, or it's the Pacer ETF. We are very much paying attention to PTBD. It is a well-built investment. However, we have found that the way that we run the investment internally here at Sound just simply does a better job for our clients. We are looking for the right time to get out of that investment when we rotate into US Treasury bonds during that US Treasury bond rally. And we'll say that again, we're looking for the right time. We're not going to make a knee-jerk reaction to get out of that position, but we feel like our portfolios would have done a lot better if we had not had it this year. And so we're going to exit it at the appropriate time. So let's be patient with it. But that means that you're going to see more trading. Our clients will see more trading in their accounts at Sound. So we want to avoid large losses by rotating out of stocks, not all stocks, because there will be some winners. And number two, we want to invest in those winners, both in the stocks and in bonds. We believe that those bonds will be US Treasury bonds in 2022. So let's be patient. We want to manage our emotions. Yes, this is certainly easier said than done. I'm not under any illusions that managing our emotions is easy, but God has blessed us tremendously. You have the financial resources to have a successful financial plan, and it's our job to help you have a successful financial plan and reach your financial goals. Investing is just one part of it. So if we have not discussed your financial goals, and if you don't know what your plan is to reach those goals, please talk to your Sound financial advisor to help you reach those goals. And that's one of the best ways to manage your emotions during a financial crisis or during a stock market crisis, is by knowing what your goals are, what your plan is, and so that you can control what you can control. Thank you for the trust that you put in us. We're here to work hard for you, and that's exactly what we're doing. Take care. God bless.